Nvidia jumped 1.9%. Moat scores 78 out of 100 overall. High durability. What operating evidence matters most for Nvidia Corporation? Nvidia's structural moat is anchored in hardware execution scale that competitors cannot replicate at volume. And another question, what could weaken Nvidia Corporation's moat durability? Controlling 72% of cloud accelerator locations, Nvidia has locked in ecosystem dominance through its proprietary CUDA, Compute Unified Device Architecture, the software framework that translates parallel processing algorithms directly into hardware execution. Walk the AI stack, and Nvidia sits as a Tier 1 bottleneck, controlling AI accelerator GPU plus CUDA software stack. The moat here is software ecosystem, and it should hold for long. Blackwell architecture in full production with high demand, but supply constraints persist via TSMC CoWoS packaging bottlenecks. Hyperscaler CapEx remains elevated through late 2025. The one force that could crack it: hyperscaler custom ASICs, Google TPU, Amazon Trainium, Meta MTA, AMD ROCm closing the 18-month gap. Nvidia's 92% GPU dominance isn't raw speed, it's software lock-in. If you skip this, you'll miss how that lock-in turns into revenue protection and why smart money is piling in. Institutional smart money is making a concentrated bet on Nvidia, with Vanguard Information Technology Index Fund increasing its stake by 9% and Morgan Stanley raising its holdings by 6%, alongside Cathie Wood's flagship ERKK fund buying an additional 8,600 shares. This sustained accumulation across major financial institutions unfolds even as the stock trades at $193.52, up 1.85% on the session, while sitting below its 20-day moving average of $202.92 and 50-day moving average. Mainstream market commentary treats this consolidation as technical weakness within a broader market rally where the semiconductor index surged 8.1%. Wall Street sees temporary price stalling, but major funds are treating this level as a strategic base. They are allocating capital into a company holding a large market capitalization and generating $81.61 billion in quarterly revenue, up 85% year over year. Capital is not fleeing the AI sector. It is concentrating into the primary bottleneck that powers the entire compute ecosystem. The broader market fluctuates on short-term sentiment, but institutional balance sheets are taking positions for the next leg of the infrastructure cycle. Wall Street tracks share price fluctuations, but the physical constraint governing revenue velocity is CoWoS, chip-on-wafer-on-substrate, with a local silicon interposer, which is TSMC's advanced packaging technology that bonds high-bandwidth memory to compute dies. The compute stack runs at a TDP, thermal design power, the maximum heat dissipated in watts, of up to substantial watts per GPU in the GB200 NVL72 rack system. While AMD's MI300X offers high peak memory bandwidth across a large total silicon area, Nvidia controls 92% of the discrete add-in board GPU market because raw memory speed cannot bypass software integration. The engineering reality is that CoWoS packaging allocation at TSMC's N4 and N3 process nodes determines real delivery volumes, not paper customer orders. Nvidia's recent research on hardware-conditioned kernel acceleration demonstrates that software optimization yields matched performance gains on existing silicon, effectively multiplying die efficiency before hardware upgrades arrive. This hardware-software coupling strengthens the structural moat far beyond what simple silicon yield numbers suggest. Quarterly financials showing modest revenue momentum for Nvidia. When macro liquidity tightens across global markets, it acts as a drag on enterprise infrastructure investments. Yet Nvidia's balance sheet absorbs macro friction through unprecedented internal cash generation. Institutional capital is currently executing a structural accumulation cycle, moving away from soft software plays and anchoring into physical silicon infrastructure where pricing power remains absolute. With the federal funds rate, the benchmark interest rate at which commercial banks lend to each other overnight, sitting at 3.63% and the 10-year Treasury yield at 4.61%, cost of capital is no longer free. Smart money sees this macroeconomic filter clearly. This low macro tail risk gives institutional funds the conviction to treat Nvidia as a high-margin utility rather than a volatile tech stock. The enterprise machine continues expanding, supported by Nvidia's 85.2% revenue growth and an extraordinary 214.5% earnings expansion that bypasses traditional debt financing channels entirely. At the policy layer, protectionist trade policy and rising international tariffs create a complex regulatory wall that smaller competitors simply cannot scale. The threat of sweeping tariff blitzes imposes heavy logistical burdens on global supply chains, but Nvidia's established operational scale allows it to absorb policy friction that would crush smaller hardware vendors. When government policy restricts advanced technology exports or imposes border taxes, it forces hyperscalers, giant cloud service providers that operate massive enterprise data centers, to consolidate their orders with the single vendor that guarantees maximum compute efficiency per watt. Regulatory scrutiny may dominate news headlines, but in corporate boardrooms, policy risk merely accelerates the flight to proven infrastructure. Every legislative hurdle or tariff threat elevates the barrier to entry, locking hyperscalers deeper into Nvidia's ecosystem. Geopolitically, the AI race has transcended corporate competition to become a sovereign imperative, turning global supply chain chokepoint risks into a permanent structural tailwind for dominant hardware providers. Nvidia's architectural dominance is anchored in Taiwan, making the physical supply chain the central node of global tech diplomacy. That foundry surge directly reflects the unstoppable global pull for advanced accelerators. Nvidia currently powers nearly 72% of cloud accelerator locations, physical data center facilities equipped with specialized chips to handle complex machine learning workloads, while maintaining roughly 92% to 94% share in discrete GPUs, dedicated graphics processing chips with their own high-speed memory built separately from the main system processor. This massive footprint creates a geopolitical moat. Sovereign nations cannot afford to fall behind in compute infrastructure, forcing governments from Western capitals to the Middle East to fund sovereign AI initiatives, national strategies to build and control AI infrastructure within domestic borders, regardless of macro headwinds or trade conflicts. This sovereign push collides with a shifting political landscape where public sentiment is increasingly critical of big tech, yet deeply reliant on national technological dominance. While voters and politicians debate energy usage, labor impacts, and big tech market power, political leaders simultaneously classify compute capacity as strategic national infrastructure equivalent to defense or energy reserves. Macro uncertainty becomes an accelerating wave. Elevated interest rates flush out weak software business models, while geopolitical rivalries force governments and enterprise giants to pour capital directly into Nvidia's silicon layer. Capital flows away from theoretical software applications and locks into physical compute infrastructure. Nvidia does not merely ride the macro wave. Its physical choke points and software lock-in define the very contour of the global AI supply chain. Nvidia Compute is trading below its 20-day average at 100. The build-out of AI factories is accelerating at extraordinary speed. Jensen Huang, CEO, earnings release. Management leads with two primary themes: AI factories and agentic AI. They want Wall Street focused on a $4 trillion TAM, total addressable market, the total estimated revenue opportunity available for a product category. Record Q1 revenue reached $81.6 billion, up 85% year-over-year. Data center revenue surged 92% to $75.2 billion. Gross margins hit 74.9% GAAP and 75% non-GAAP. To solidify investor confidence, management announced an $80 billion share repurchase authorization. They also increased the quarterly dividend 25-fold to 25 cents per share. Management issued second quarter revenue guidance of $91 billion. This guidance implies continued quarter-over-quarter expansion across all data center segments. This PR framing invites investors to view hyperscaler CapEx, capital expenditure, corporate spending on physical infrastructure, as an endless tailwind. Corporate communications carefully direct public attention away from executive equity exits. While leadership broadcasts extraordinary structural growth, company insiders net sold 1,901,125 shares over the past 90 days. Corporate executives sell stock for various personal reasons. However, heavy net liquidation during record quarterly performance sends a clear counter-signal. Management uses balance sheet cash for an $80 billion corporate buyback to support share prices. Simultaneously, executives are reducing their personal skin in the game. Short seller flow shows daily short volume at 36.2%, matching the historical 38.9% baseline. Bearish speculators are not driving market volatility. The consistent supply hitting the market comes directly from corporate insiders. Retail sentiment remains 73% bullish on StockTwits. Reddit activity ranks this ticker 7th in overall mention volume. The retail crowd buys the PR narrative while management unloads equity into retail liquidity. Microsoft reported 43% cloud growth, igniting a broader chip sector rebound. Yet insider sales reveal true management conviction behind closed doors. What management says is infinite infrastructure demand. What the lab sees is executive profit-taking at peak pricing levels. Smart money fund managers are playing a completely different game than retail. In 13F filings, quarterly SEC disclosures showing institutional equity positions, Vanguard's IT fund added 9%. Morgan Stanley added 6% to its institutional holdings. Cathie Wood's ARKK fund purchased 8,600 shares. Total institutional ownership sits at 70.7% across 7,564 funds. Institutional buyers look past near-term headline noise and monthly semiconductor ETF declines. Smart money sees non-hyperscaler enterprise buyers and sovereign AI projects creating a permanent revenue floor. The real tension is hidden inside the earnings call Q&A session. Analyst Ben Wrights is asked whether Nvidia can grow faster than hyperscaler cloud budgets. Jensen Huang insisted they will grow faster across all regional markets. We expect to grow faster than hyperscaler capex overall. Jensen Huang, CEO, Q1 2027 earnings call. Management points to sovereign computing to deflect from cloud disintermediation risks. Cloud giants are actively deploying internal ASICs. Application-specific integrated circuits, silicon custom designed for dedicated workloads. Key examples include Google TPU, Amazon Trainium, and Meta MTI. These custom chips bypass CUDA, Compute Unified Device Architecture, Nvidia software platform, at the infrastructure layer. That represents 8.6% of revenue, up 43.2% year-over-year. This extends an unbroken four-quarter beat streak. Here is your 90-day checkpoint. If R&D drops below 8% while insider selling continues, the bull thesis breaks. That structural drop will prove management is sacrificing long-term silicon innovation to artificially protect short-term operating margins. The momentum breakdown for Nvidia. RSI sits at 35, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Nvidia's structural mode is anchored in hardware execution scale that competitors cannot replicate at volume. Controlling 72% of cloud accelerator locations, Nvidia has locked in ecosystem dominance through its proprietary CUDA, Compute Unified Device Architecture, the software framework that translates parallel processing algorithms directly into hardware execution. The physical transition to monolithic multi-die architectures and fast HBM3e, high-bandwidth memory third-generation extended, which stacks dynamic random access memory dies vertically to eliminate bandwidth bottlenecks, cements this performance lead inside Blackwell GB200 NVL72 rack architectures. In Q1 FY27, Nvidia generated $81.6 billion in total revenue, driven by $75.2 billion in data center revenue, up 92% year-over-year. However, hardware dominance faces severe structural erosion at the infrastructure layer. Cloud hyperscalers are actively bypassing the CUDA software stack by deploying internal custom ASICs, application-specific integrated circuits, tailored silicon chips engineered exclusively for dedicated machine learning workloads like Google TPU, Amazon Trainium, and Meta MTA. Mercury research data shows Nvidia's discrete add-in-board GPU market share slipped from 94% down to 92% as AMD's open-source ROCm, Radeon Open Compute, the software stack designed to execute code across non-Nvidia GPUs, narrows the software gap. Geopolitical friction compounds these physical risks as stringent BS, Bureau of Industry and Security export controls that cap hardware compute density, restrict H20 and tailored Blackwell shipments to Chinese hyperscalers. Furthermore, production remains constrained by TSMC's CoWoS, chip-on-wafer-on-substrate, the advanced packaging process that integrates compute dies with high-bandwidth memory. Institutional filings show Vanguard added 9% and Morgan Stanley added 6% as standing conviction, while daily options flow reflects a bullish put-to-call ratio of 0.58 alongside Cathie Wood's ARK trades, adding 8,600 shares in ARKK, while trimming 3,728 shares in ARKQ. Can non-hyperscaler enterprise and sovereign compute expansion offset the margin compression caused by custom cloud ASICs bypassing CUDA? With the stock trading at a relative strength index of 35.9 alongside bearish MACD, moving average convergence divergence, a momentum indicator measuring trend directional strength, short-term market sentiment reflects cloud capex fears, but smart money looks past technical indicators. Smart money recognizes cloud provider budgets act as a floor, not a ceiling. While cloud giants optimize standardized workloads on custom ASICs, sovereign nations and enterprise clients lack the engineering capacity to build custom compiler pipelines. They require immediate off-the-shelf hardware integration, anchoring their infrastructure to Nvidia's architectural ecosystem. This non-hyperscaler expansion drove ex-China data center revenue up 120%, proving that enterprise capital flows directly into Nvidia's highest margin rack systems regardless of hyperscaler silicon substitution. The lab assigns Nvidia a Moat durability score of 78 out of 100, reflecting resilient ecosystem retention balanced against advanced packaging bottlenecks and internal cloud silicon adoption. At a trailing P/E price-to-earnings ratio, which measures share price against per-share net income, of 29.6 times, and a forward P/E of 15.0 times. This score evaluates structural moat longevity, never short-term price attractiveness. If sovereign AI deployments and enterprise Blackwell rack deliveries maintain ex-China data center growth above 100% while defending gross margins above 74%, it proves Nvidia can outpace cloud capex cycles by capturing global enterprise capital. The single-sourced operating metric determining this balance is the trajectory of ex-China data center revenue growth relative to gross margin stability. Smart money is positioning for the sovereign compute catalyst, where software ecosystem density insulates hardware margins from hyperscaler disintermediation. Here's the macro picture shaping Nvidia. Stringent BS export controls severely limit shipments of high-performance GPUs like the H20 and tailored Blackwell variants to Chinese hyperscalers such as ByteDance and Tencent. Furthermore, Nvidia remains structurally exposed to Taiwan geopolitical risk due to total reliance on TSMC for leading-edge N4/N3 nodes and CoWoS advanced packaging. The transition to monolithic multi-die architectures and fast HBM3e memory is driving demand for Nvidia's Blackwell GB200 NVL72 racks and Hopper. Nvidia is operating at the absolute climax of the AI infrastructure expansion, guiding Q2 revenue to a staggering $91 billion behind Blackwell system ramps. Management is aggressively reframing the corporate narrative from GPU hardware vendor to an end-to-end agentic compute platform, opening a brand new $200 billion TAM with the Vera CPU. However, with gross margins plateauing at 75% and price trading below its 20-day and 50-day moving averages, peak phase expectations leave zero margin for error. Over the next 2 quarters, the lab expects earnings execution to stay pristine, but multiple expansion has run its course. Nvidia doesn't just lead its peers, it laps them on revenue growth, and the gap is widening at 85.2%. Let's start with AMD. That 143% YTD run is flashy, but peel back the layers. AMD's 37.8% revenue growth is less than half Nvidia's. Their 53% gross margin is solid, but it's not the 70% plus Nvidia prints on AI accelerators. Where AMD wins. Valuation sanity. 161.9x P/E is eye-watering, but it's still cheaper than Nvidia's unprintable multiple. The edge here is psychological. AMD stock is pricing in a future where they catch up. Nvidia stock is pricing in a future where they stay ahead. Intel's turn. That 100% YTD pop looks strong, but the fundamentals don't back it. 25.4% revenue growth is respectable, but it's a third of Nvidia's. Gross margin at 39% is a red flag. Intel's foundry struggles are real, and their AI chips are late to the party. The edge? Scale. Intel's fabs and legacy CPU dominance give them a structural moat in supply chain control. But scale without margin is just volume. Nvidia's 85% growth and unmatched AI demand make Intel's edge look like a relic. Qualcomm is the outlier. Flat revenue growth, a pedestrian 7.4% YTD move, and a 17.3x P/E that screams value trap. Their 55% gross margin is impressive, but it's built on smartphone chips, not AI. Where Qualcomm wins. Capital efficiency. That P/E is a fraction of Nvidia's, and their margins are durable. But durability without growth is stagnation. Nvidia's AI-driven revenue surge makes Qualcomm's edge irrelevant in the race that matters. Now, the valuation check. Nvidia's P/E isn't just high. It's undefined, because the market is pricing in a future where their growth compounds indefinitely. AMD's 161.9x is steep, but it's a discount to Nvidia's implied multiple. Intel's 45x looks reasonable until you realize it's propped up by legacy businesses, not AI. Qualcomm's 17.3x is the only sane number here, but it's a value trap for a company stuck in neutral. Capital efficiency is where Nvidia's moat becomes undeniable. Their 85.2% revenue growth and industry-leading gross margins create a flywheel. Higher volumes, better pricing power, and R&D dollars that outpace competitors. AMD and Intel can't match that combination. Qualcomm's margins are strong, but their growth is flat. Nvidia's operating durability isn't just better, it's in a different league. The verdict? Nvidia's moat doesn't just lead, it's widening. The only thing that could change that is if competitors close the AI revenue gap. Until then, Nvidia isn't just ahead, it's alone. Nvidia's durability score of 78 isn't just a number. It's proof their silicon lead is structural, not cyclical. Which engineering constraint most threatens Nvidia Corporation's moat? Give us your evidence. This isn't financial advice. We're engineers, not brokers. Markets change, tech evolves, and past performance never guarantees future returns. Always run your own numbers before pulling the trigger. If you want our full breakdown on AMD, the link is in the description. Subscribe so you don't miss Thursday's deep dive. We're tearing down Seagate. Stay sharp, Lab.